welcome back to Investing Talk Podcast.
Today we're looking at Eastern International.
All right, and as usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. I think we need to start with the fundamentals.
Yeah, you have to. So where do we begin? The core business. Right, the logistics.
Exactly. Eastern International has shown some really strong momentum, especially this last year, and that's largely been driven by that core logistics business.
Okay, so let's unpack the numbers. What are we seeing?
Well, for the full year, they reported revenue of $40.4 million.
Okay, solid.
But the really impressive figure is for the 6 months ending September 30, 2025, they saw a huge 27.8% year-over-year revenue increase.
27.8%.
Yep, reaching $27.2 million. And that's pretty much all coming from strong demand for their transportation services.
Okay, a near 28% growth rate is, well, that's eye-catching. But my first thought is always debt. You know, how much did they have to borrow to fuel that kind of growth?
And that's where it gets really interesting. You'd expect them to be heavily leveraged, but they're not.
Really?
Yeah. I mean, their net income did rise a bit more modestly, about 6.5%. And we should note that gross profit was slightly squeezed by competitive pricing. But the balance sheet itself is surprisingly conservative.
How conservative are we talking? What's the debt to equity?
It's just 0.35.
0.35.
Wow.
So for everyone listening, that basically means for every dollar of equity they have, they only owe 35 cents in debt. That's a ton of control.
It's extremely controlled. It shows they aren't relying on massive debt to get this done. And that efficiency, you know, it shows up in the returns.
Right, the ROE.
Their return on equity over the trailing 12 months was a strong 16%.
Which is, what's the industry average? Around 15%?
Exactly. So they're meeting or even beating the industry average.
Yeah.
It just shows that management knows how to use capital well.
And speaking of capital, they got a huge injection of it right before this big pivot, the IPO in August.
Oh, that was absolutely critical. That IPO brought in a $3.6 million cash influx.
Which is basically the launch pad for everything we're about to talk about.
It positioned them perfectly. It gave them the liquidity to reinvest without having to, you know, dilute shares or take on a bunch of high-interest debt.
Okay, so the foundation is there. Profitable, growing logistics business, very little debt, and a pile of cash.
Right.
But the real story here isn't just about shipping things. It's about what they're building towards. How are they future-proofing?
Well, this is where it gets fascinating. They're evolving their competitive moat. I mean, originally their advantage was in specialized logistics, right? Cross-border projects.
Yeah, moving the big, complicated stuff.
Exactly. Now they're integrating vertically. They're moving into new energy infrastructure.
That feels like a huge leap. I mean, logistics and heavy construction are very different worlds. How do they bridge that gap?
They bought the bridge. The key move was the acquisition of Gizu Minji Construction Engineering on October 27, 2025.
So they just acquired the qualifications they needed overnight.
Pretty much. This gave them immediate qualifications in power engineering, transmission, and most importantly, new energy infrastructure.
So wait, let me get this straight. Before, they were the experts at shipping all the parts for a giant solar farm. And now they're actually qualified to build the solar farm itself.
That's the game changer. It fundamentally transforms their entire service offering. Think about it. Their pure logistics competitors can't match that.
And it creates really high switching costs for clients, right? You'd much rather deal with one company that does it all.
Precisely. And the validation for this strategy, it came almost instantly.
That's what I wanted to ask. I mean, an acquisition like that usually takes months, maybe a year to even digest.
I know, but they secured a $6.04 million photovoltaic contract for the first phase of a 50-megawatt solar project.
A $6 million contract right out of the gate.
Right out of the gate, it just proves the market is ready for this kind of integrated provider. It's working.
So the market perception must be shifting. What are the big headlines driving this?
Well, you've got three main things. First, obviously, is that $6.04 million solar contract win. That's the proof of concept.
Right.
Second is the acquisition itself, giving them the operational ability. And third, and this is what drove the recent stock pop, is their push into the European market.
And that gave the stock a, what, 13% boost in one day?
13.03%, yeah. The enthusiasm is definitely there.
But here's the thing that feels like a disconnect to me. You've got this 28% revenue growth, this huge strategic pivot, and the stock is trading around $1.52 with a PE ratio of 10.
10.51, yeah.
That feels incredibly low for a growth story. Why is the market still pricing them like a slow-moving logistics company?
And that's the core insight here. The market is often slow to re-rate a small-cap company in the middle of a big transition. It's still valuing the old business, not the potential of the new one.
Which suggests it might be undervalued.
It strongly suggests potential undervaluation, but with a big caveat, if they execute successfully.
Okay, and what are the technicals saying? Where are analysts seeing support?
The chart's been volatile, for sure, but the trend is fundamentally bullish. Analysts are highlighting that $1.40 to $1.52 range as a pretty attractive entry zone. It looks like it's building a base.
So it's consolidating.
Yeah, and you're seeing momentum build. There was a recent 21.6% recovery from intraday lows, which is a great sign. The whole picture suggests the market just hasn't fully caught on yet.
So what's the next trigger? What's the date we should be circling on the calendar?
The most immediate one is the start of that solar project, phase-on. It's scheduled to begin before December 31st, 2025.
So very soon. That's the moment it goes from paper to reality.
Exactly. And longer term, they're perfectly positioned. They're sitting right in the middle of these massive macro tailwinds, the renewable energy push in China, global infrastructure spending.
Okay, so we've laid out a lot of the bullish case. It's compelling. But you mentioned volatility, and that's a huge red flag for a lot of people.
It is.
Let's talk about the bear case. What are the key risks here with such a rapid expansion?
The volatility is the #1 risk. And it really comes from the fact that it's still a pretty small company. Small caps just naturally have these wider swings. You see a 29% surge, but you also see a 40% drop.
And a 40% drop can definitely shake your confidence. What's the other part of that? The size.
Yeah. I mean, some investors look at the $40 million in revenue versus their liabilities, and they get worried that this whole thing could be a speculative bubble. They're asking, can a company this size really pull off such a dramatic pivot?
Which brings us right back to execution risk. Success isn't guaranteed here. What happens if they can't integrate the acquisition smoothly? Or if margins in the solar business are even tighter than in logistics?
That's the absolute core vulnerability. You have the risk of merging cultures and skill sets, and you have market risk. If they stumble on this first $6 million contract, it could really damage the reputation for future bids.
So what's the counterargument to those fears? What in the financials helps mitigate that?
It all comes back to that conservative financial foundation. That debt-to-equity ratio of 0.35 is their safety net.
Right. It gives them breathing room.
A lot of breathing room. And their return on invested capital, the ROIC, is a solid 7.86%. It shows they use their capital wisely. They're moving fast, yes, but they're doing it from a position of internal strength, not just with borrowed money.
And the low valuation at $1.52.
Yeah.
Does that suggest the market is already pricing in some of this execution risk?
I think it absolutely does. Between the cash from the IPO and the current low valuation, it feels like the market is well aware of the risks. So what you're left with is a higher risk, higher reward play.
Where everything hinges on the successful completion of that new contract.
Precisely. The whole bullish thesis rests on it.
So what kind of time frame are we looking at for this to play out?
The focus is really on the next 3 to 6 months. Analysts are looking at it as a swing trade into the Q1 2026 earnings report. Any and all updates on the execution of that solar project are going to be critical.
So to sum it all up, we've seen a really strong logistics company use its IPO cash to make an aggressive pivot into renewables, and they've landed a major contract right away, all while keeping a very clean balance sheet.
Right. And I think the big question you, the listener, have to consider is this. Does the market fully appreciate what it means to go from just moving infrastructure to actually doing it? That integrated model is pretty rare.
And if they pull it off?
If they execute successfully on these first solar projects, if they deliver on time and on budget, then that $1.52 valuation might look completely different 6 months from now.
Great analysis. If you enjoyed this overview of Eastern International, don't forget to subscribe to the podcast for all our future deep dives. We appreciate you tuning in.